It's not looking as peachy as it once was. The Kansas City Federal Reserve Bank President Esther George just said that she expects the federal fund target rate to be above 5%. Now, I don't think that's really a big surprise to anybody, but now I guess it's out there for public knowledge. So she basically said in her recent interview that she doesn't expect a recession, but if the Fed doesn't get this right, this could be, they could put a recession on the table for us pretty easily, even a depression if they really mess this up. I don't think they're going to really mess it up, but it is on the table if they let the price wage spiral basically take place, which is not super likely, but let's head into the interview and see what she said a little bit.
How much of a differential do you see? How much of concern is there that you have that the market is pricing in these cuts after hitting that peak rate, whereas you apparently are not pricing that in?
Right. So I think this is a very different time. If you think about where we've been over the last 2 decades, we haven't had high inflation, we've had low rates. We're now moving into a very different time. And I think for myself and for my colleagues, we understand that high inflation is going to require our action.
So she said that the price pressures are falling and this is a good sign, but she doesn't expect this to change her opinion on what the interest rates are going to be. And she expects interest rates to be above 5%, like I just said. And so we're looking like the 5 to 5.25 range, which is going to really upset mortgage prices, car loan. Like anytime you get a loan or even your credit cards, that's going to influence those interest rates quite a bit. It's also going to influence savings accounts, which should be better for you now. She even said that there's a lot of money sitting on people's balance sheets, which means it's in their savings account or it's basically liquid cash, meaning they can spend it whenever they want. And this is a good thing for inflation. You want to know why? Well, if they don't spend it, that means it's not contributing to our GDP. And our GDP, the gross domestic product, basically meaning services and goods of America, if the GDP is growing, that means that inflation is possibly growing too. So if GDP is shrinking, that means inflation should also be shrinking. So if they're not spending their money contributing to the GDP, that means the economy should be shrinking. So this is a good thing for inflation. So the reason inflation is just crazy over this past year is because of a number of issues, but mainly due to the pandemic and the supply chain issues where we were just growing so fast the supply chain couldn't keep up. So since demand was super high, people could charge crazy prices for things, and then it just kept stacking on top of each other. And now we have, 9% inflation or something like that over year. But now the growth has stopped and people have started saving their money. I think recently it says 72% of Americans say that they have cut back on at least one item to meet their monthly expenses. So why is this a good thing? Well, like I said, we want to keep inflation in control. And if people aren't spending money, they're not contributing to making the economy bigger and growing too fast. So with people holding their money, that means we can rein it back in and really see the Fed policy at work. And if the Fed policy is working, that means the economy is shrinking. So basically, with simple terms, means the more hurt, the more inflation comes down. And we don't want that hurt to trigger a recession, but it's totally on the table right now. So during their December meeting, they basically said if people are predicting, especially the equities market, a federal fund rate pivot, they're going to punish that pretty severely. They don't want equities to rally. They don't want this to happen because if equities, meaning the stock market or something, rallies and looks like a positive note, that's going to be the opposite of what the Fed is trying to implicate. They're trying to make the Fed they're trying to make the stock market go down and people, like I said, the shrinking economy, they want everything to go down. Now, ideally, they want it to go down steadily to where people aren't getting out of control or just a nice gradual. They don't want to jump off the cliff. They just want to kind of coast down the hill. But if we start going back up the hill and good things start happening, that's going to start pushing us towards the cliff, okay? So if the cliff is this way and we can just coast down, we just want to coast down. We don't want to go up towards the cliff. Cliff, bad. Because the rally would start meaning things are going good and people are going to start spending that nest egg that they're very happy that they have right now. So they want to keep that savings account that Americans have and not spend it. So if the markets start going up, people are like, oh, things are going super well. I'm going to go hire more people and do more things. Yeah, that's not what they want. So if the market would start rallying, they're just going to increase the Fed fund rate. So it's basically a big deterrent for people to start investing in the market because historically when the Fed fund pivots, meaning that they start slashing rates, that's when the market has taken off. So they don't want people to try to predict that and try to get into the market early. They're saying, hey, 2023, we're not letting the market increase. We're not going to help it out. We're just going to keep increasing rates. So that's bad news for the market, but they need that bad news. They need that bad news to be the catalyst of just a steady decline. So that's the best for everybody. So during the meeting, there was zero members saying that the interest rates were going to go down in 2023. They said in 2024 is when to expect interest rates to go down. Now that's kind of backpedaling on what they previously said, and the market had priced that in a little bit. So that is why we saw a big drop in the market during that conference. Is it real? I don't know. My thoughts is it kind of comes down to if the Fed is bluffing or not, because they're, like I said, it is very important for them to make sure the market doesn't do anything crazy good or any rallies like that. Maybe a little bump in the road, but they just want to see that downhill effort. So by them telling everybody, hey, we're not going to lower rates in 2023, and the lowering of rates makes the market go up, that we're only going to be increasing rates in 2023, that's basically showing their hand that hey, we just want the market to go down. So my thoughts are basically, is the Fed bluffing or not? I don't think they're bluffing if the stock market starts to go up. I think they will raise rates and make sure that comes down. Like, that is their one priority, is that downhill slide, that nice slope. And if they see that's a good thing, because if they see that nice downhill slide that I was talking about and everything, then they might be bluffing for the 2023 rates. And they might be saying, hey, we're not going to be lowering rates in 2023, but if things start sliding nicely downhill, they might change course on that. And then in 2023, towards the end of the year, they might say, hey, we're cutting rates. But they kind of want to put that message out there that they're not going to do that. That way they see that slide that we want. So basically, I do think we should expect 5% federal fund rate. And I do think we should see everything get worse. And the Fed, they said, we will punish things if things start going too well, they're going to punish it. They're going to induce maybe a recession. So expect that. They just don't want to see anything crazy for 2023. That's basically it. Subscribe for more news like this.